and welcome to Options Guide TV. My name is Brian Overby, the author of The Options Playbook, and your host for the next 30 minutes here on Options Guide TV. So, man, the bulls want to run. We see the S&P 500 index up again, almost about 0.6%. We got the Russell 2000 index also up, which is always a good thing in this marketplace, especially considering where interest rates are at. We got the VIX index actually down about 50 cents on the day, trading at 1367. And we got news in our BlackRock stock. Unfortunately, we didn't have the opportunity to actually roll out of this trade. We talked about it on Wednesdays or on Monday's show. Today's Wednesday. And just staying the course on BlackRock, but unfortunately today we actually blew through our short strike, and I say unfortunately with quotation marks because overall it's a good thing. The position is doing well on the BlackRock stage, but if you recall, if we go back to when we entered our trade on BlackRock, let me give you a quick summary of what was going on. We just wanted to get bullish on BlackRock, and it's $1,000 stock. There aren't a lot of them in this marketplace because all the big mega cap tech stocks split. NVIDIA, Google, Amazon, it also split over the last year or so. And so we have $1,000 stock, and it's expensive to buy 100 shares of it. So a great scenario to buy a deep in the money call option. We started looking at the deep in the money call options, and I was just not comfortable with bid-ask spreads. And that's probably, if it wasn't for liquidity issues in deep in the money call options, I don't know why I would, that would be like the only strategy that you would do. If you could get nickel wide quotes in, on $19, $20 option contracts, and you could do it as a stock replacement, that would be the easiest strategy to work with. But BlackRock just doesn't seem to be liquid enough. So we were wide on our bid-ask spread, what was about $2 wide, and decided that to be more realistic, we needed to sell a call against the position. In other words, we needed to come to the floor with a package. We're going to buy a deep in the money call option. We're going to sell a short-term call option against it. And then it made it more feasible to get a fill closer to the midpoint. It's very hard to buy a one-leg option strategy on a fairly illiquid underlying. I'm not saying it's really illiquid, but it's a lot less liquid than the mega cap tech stocks. And get it filled, and just get it filled at a midpoint. Whenever you put in an order, you do change the bid and ask. It does get offered, so you can adjust the trade. So if you put in a buy order and that buy order is in at the midpoint, what you will see is that the bid will come up to where your limit price is. And that's saying that there is a good buyer out there that's willing to give better than what the market makers are willing to give down on the trading floor. So if you're selling, you can sell to this buyer that's in the public space. That's short of it. Okay. So if you come to the floor and you want to trade with the market makers, if you give them a package, you can sometimes trade better. Now, I bring all this up because we weren't that excited about selling the call option at that point in time. Very rarely do I just want to buy a deep in the money call and then sell an option contract the very first day, because I'd really like the stock to run. And let's run now to the Tradier Pro software, and I want to show you what's going on with BlackRock. So this is where we were 2 days ago, right around the 150 level, came down. It looks like we got a little bit of support from the 20-day moving average. And then we obviously broke out to new highs here from the right at the 1,060 level. The stock right now is 1,077.89. It's up 20 points today. It's not huge on a percentage basis, but what it did was it went and blew through our strike here. We were trading right around 1,055, and that's where our short call option was at. When we put on the diagonal trade, 1,055, right? 950, 1,055. And we bought the 950 call. So now we got to roll that option contract, and we got to hope that we can get that roll off for a decent price. So let's go and look at BLK, and we'll look at, and it was really sad because we were very close to the expiration date. The expiration date for that option contract is the 20th. So we are, well, I guess not extremely close. We're 9 days away. I was thinking it was sooner than that. I was thinking it was this week, but okay. So it's on the 20th. So let's go in and look at how we would manage this position. And once again, we only trade during Options Guide TV. So I would have wanted to do this as much as I could on the open, knowing that the momentum was there. But it's strong today. A lot of strength going on in it. So here's the 20th as opposed to the 13th. I was kind of hoping it was the 13th, but it's not. 1,055 is the option contract that we are short. 1055. So we have to buy that option contract, and then we have to go out in time. And I think we're going to probably have to go out to January, and I don't mind going out to January. And this option contract right now is 29. Let's see, is there something we could sell? The 60 is 30. We can't sell something that's out of the money. All right, so we're probably just going to close this because the one that you'd want to sell right where the underlying is at is trading 24 by 19. So let's put this in and see where the midpoint is at. This would be the one we would sell. So you're looking at paying a debit of $8.55 to roll up and out in strike. That's a lot to get $3 more on this underlying. We could go, we got earnings here, so we could definitely get some bang for our buck after the earnings. So we could go out to the 37th if we wanted to. Let's see what type of juice we get on the 30th. Let's look at this expiration. So that's 24. We're still not there. If we go out to the 30th, the 37th, that's how far we would have to go to get this done for a net credit. We'd have to go out 37 days, and we'd be selling the 1,080 strike call, and we'd be dealing with an earnings report. But besides that, it's a great roll, and I say that sarcastically. Okay, so the fact that it blew through our strike and is up 20 points today, and we didn't get a chance to adjust the trade, I think we'll just close out the trade. So our official closing trade on this, and let's see how, what we ended up with on the strategy. And I do agree that we really did have to make this a diagonal, otherwise known in the options playbook. I call it a fig leaf because you're kind of covered, because you don't want to be assigned on this position. You're long a deep in the money call option as a surrogate for the underlying stock. You would have to either exercise that option contract and give them stock, or you'd have to go out on the options marketplace and actually buy the stock to give for that assignment. So the fact that we gapped open is really, it really hurts this type of trading, except for the fact that we still should be up. We just didn't participate as much on the upside. And I've really liked the stock in general, except for I don't like the width of the bid-ask spreads. Okay, so here we go. 990 by, so the option contract that we bought was the March 21st expiration. So let's clear this out, and we're just going to see what the closing trade is at. March 21st is 100 days away. And we went and bought the 950 strike call option. Bought this one. And then we went and we sold the nearer term option, the December expiration. And we sold the 150 1055 expiration. 1055. 1055. We sold that. Okay. So when we put this entire trade on, our net debit to the account, if we could fill at the midpoint, which would have been an if, was 9150, according to my screenshot. 9150. And we now could flip the script here. And we are showing my screen, right? Okay, so we could flip the script. This is our position right now. We would be doing extremely well if we hadn't sold the call, but now we're just doing kind of well. We put the trade on for 91.50. We could sell it right now for 118.60. So 118.60 minus 91.50 means we're up $27 times 100. We're up $2,710 in 2 weeks on this one position. So we flip the script. We'd come in, we would sell to close, and we would buy to open, and that would be our position. Now, this would be a sell to close, not a sell to open. So we'd be selling the March 21st 950 strike call, and at the same time buying to close the December 20th 1055 strike call. We're going to do this for a net debit to the account of $118.16. This would be a net credit, right? This would be a net credit. I don't know why that's bringing a net credit of $118.60 to the account. Okay, there it went. Okay, it just flipped on me. And that would be our trade. That's the way we would finish it. Now, I've had trades like this before, and this has happened in my own personal account where you did fall asleep or you got a gap opening and you just didn't get to the market to close it soon enough. But if you do have a position on where you're short an option contract and it gets to your short strike, in our case, it gets to 1,055, you do want to roll it at that point in time. You don't want it to get more than, I would say, 1% in the money. If you do get about 1% in the money based off of where your call strike is at, it depends on the underlying, depends on volatility, but it makes it really hard to roll up and out in time and get it done for a decent net credit to the account. It's that simple, that straightforward. And in this instance, that was obviously the case. So you got two choices then. You can either close out the entire trade, and if that does happen, you're almost always going to be profitable. If you do have a situation where the stock has gone up and that was your forecast, it just went up too much too fast. Well, we are profitable on the trade, had actually a real decent profit on a percentage basis relative to the capital that we put into the trade. Now, the other thing that you can do is you can buy back the short call, but that's a risky situation because you are taking a loss on the short call. And if the stock comes back, well, you could take a loss on the short call and then have the market come back and actually end up losing on the long call. So it's a real tough choice to just buy the short option contract back. And I think in our instance, you're paying right here, you're paying $26 for that. And we probably put that thing on for a couple of bucks when we first initially sold it. So I don't know exactly the number. So that's a real tough thing to do in that scenario. So that's where I'm at. I close it out, get a positive trade, get a winning trade, and then just be sad that we got blindsided on this big gap opening today, up 2%, $22 at this point in time. Next, Amazon. So Amazon is doing well. It looks like the whole marketplace just really wants to go up, and I don't know what is going to stop it at this point in time. Obviously, inflation could have a big part of it, and so far the data, jobs data, everything that has came out economically this week has not spooked the market whatsoever. 229 is where Amazon is up. That's up $4 on the day. We looked at the chart on Monday. We said we got bullish on Amazon more than once, and rode some of the momentum to the upside. Saw a little bit of support to the downside right now, just a little bit of a sell-off. So we sold a short call spread. We ended up selling a very near-term one. We're going out to the 20th, and we sold the 217.50 strike, $217.50, and bought the 212.50 strike. And we did it for a net credit to the account of 56 cents. We should close that trade at this point in time, December 9th. We should be able to close it out for a dime or less. Let me take this one and send this to the what if calculator just to do that. And then we'll come back to here and we will look at doing the Amazon trade. The Amazon strikes were 217.5. So we sold this one. So I'll set it up the way that we initially put it on, and 215.5, and we bought that one. Oops. This one. 26 cents. All right, not quite enough. We need that to trade for around 15 cents or 10 cents before we want to close it. So we've made half the premium on the trade. We put it on for 56 cents, and now we see it trading for around 26 cents. So if I have this trade on right now, I'm going to flip the script and say we're going to buy. I'm going to have this order in for the rest of the day. We're going to buy to close the 217 contract, sell to close the 212 contract, and I'm going to do it for a net debit of 15 cents. If I can get out for 15 cents today, I'm fine with that. I would leave that in as just a one-day trade to close out that position, try to capture as much of that premium as possible. And I would take that at this point, considering that it's trading for about 26 cents right now, and it's up 2% on the day, much like BlackRock is. Okay. Next off, we have our SPX trade. And so far, we got the S&P 500 index up $42. It's at 60.77. And when we put the SPX trade on, we were at 60.54. Okay, so let's look and see where that trade is at. So neutral to bullish on the SPX, I would say. And the skip strike butterfly is a very schizophrenic trade in that it starts off that it wants to be bullish on the marketplace. And then by that expiration date, it's okay if it's a little bit bearish. And basically the way that I look at the skip strike butterfly, and I went through a lot of detail on Monday about it, is I'm selling a credit spread. It's an alternative to a credit spread. And I'm taking the credit and I'm paying for a butterfly. That's why I'm doing that trade. That's why I'm setting it up. I'm not looking at it as an alternative to a butterfly. I'm looking at it as an alternative to a short put spread. So we used puts in this scenario. SPX, let's make sure I got my dates right because I did screw that up last week. 12/13 is our expiration. So 12/13, 2 days away. And there's just so many expiration dates in the SPX. You always got to be very careful when you're setting up or closing your trades. Okay, third 60/30. Here's the one that we bought. 60/20 is the one that we sold, and we sold it 2 times. And then we skipped a strike, the 60/10, and went down to the 6,000 strike, or 60, yeah, 6,000. Let's just call it that. Okay, so now I think I take this trade off. We got a midpoint credit. 1 day is one away. We're trading at 25 cents. I think I'm going to flip it, make the buys sells and the sells buys, and I'm going to close this off for 20 cents. We did that entire trade for $1.35. You could maybe work it a little bit today, see if it comes down to 15 or 10. I would put an order in at, gosh, we're at 20 right now. I'd put an order in at 10 cents to close everything and see if we could just get out of the trade. I don't want the risk right now. It's if we were at this place on Thursday, where right now the SPX is 60.78, and this is just the dynamics of option pricing and understanding it all. if it was Thursday afternoon and the market was here, I would ride it out a little bit because I'm okay with the trade because we have a hedge on it. And let me send this to the what if calculator and explain a little bit that way. But if I can get out today and I can make the maximum credit without all that risk, here's where the market's at. Here's where our risk still is at. As expiration approaches, then this actually becomes profitable. And this is what I mean by just the outlook of this trade. It's a very odd trade. So ideally, we put this trade on, compare this to selling the 610 call and buying the 6,000 strike call. If you get a chance to take off any of that credit, you're going to do it. No matter what, if you just did a short put spread and you could buy it back for 20 cents, you would think very hard about doing it, but you would definitely buy it back for 10 cents, right? You don't want to mess with the risk. Well, in this instance, this is where we're at right now. We actually have a long spread. It behooves us if the market actually comes down and stops right at that 620. We could make the net credit received, which was $1.35, plus additional money if we can get the market to come down and stop in there. So we did it on Monday. We've almost made the net credit, which was our goal because, like I said, this was an alternative to a short put spread. But now if I grab the date inside the what if calculator and we move forward one day, this line's going to move up a lot. Okay. But this is as of today. Remember, we put this on for a much bigger net credit on Monday. All right. Didn't move up a lot. Now we go to Friday and then we move up a lot. So in this instance, based off of the theoreticals, from Friday at 11 p.m. until the close, we can actually add a couple of hours on here. Let's go to 13:21. And now we'll go to 14:21. And now we'll go to 15:21. And you see how dramatic the time decay is on that Friday. And we could even run back. Let's go and see where we'd be at Thursday, the 12th. We still even 15:21. We're still actually at this little pivot point. So we still need one more day's of time decay. Okay, so here's the moral to my story. To summarize up my rantings, if the market was at this level on Thursday, and I could guarantee that the market is going to stay at 60.79 or above, I would stay in the trade one more day. We put this trade on Monday. We received a real nice net credit of $1.35. We can now take it off, according to this, at a midpoint price of 20 cents. I don't think I want to take the risk overnight. I got a solid trade, and that was on $1,000 requirement, which is this risk right here, showing at 980. It was actually a little less than that because it's 1,000 minus the net credit received of $1.30, and that was our max risk, and we got most of it. So, considering today is Wednesday, I don't really want to stick around. If it was Thursday, this point in time, I would be more apt to do it, especially in the SPX, because you're not necessarily going to get blindsided by a 2% move on the open. It just, like what happened in BlackRock, is the reason why I mentioned that. SPX might move 2% in a day. It's feasible to do it, but it usually just doesn't gap open 2% because you have 500 stocks. And very rarely do you get these huge gap openings. It usually meanders throughout the day and gets momentum either to the upside or the downside, which gives you an opportunity to get out of the trade. There you go. If you have any questions about this, please do put them in the comment section. If you are in the Tradier hub, hub.tradier.com, and you build a login, you can ask questions via that platform. You can also do it in YouTube, and you can do it inside the x.com platform, where we stream live via my handle at Brian Overby, and also via the Tradier handle inside x.com. Brian Overby, simply my name, at Brian Overby is my handle in x.com. All right, so now I want to add one more trade. We just had so much stuff happen in the underlyings that we're trading. So let's go back, and I've always kind of been a fan of Google. They came out with an announcement about a new chip that they're all excited about. I don't know how they kept it under wraps, but it makes people feel like the biggest thing that has been holding Google down is perceptions that they're going to lose their handle on search. And they basically have a monopoly on search. So, because of that and AI, everybody felt like Google is behind the ball. And I'm guessing this is my interpretation of the news that came out yesterday. Because if you look at the stock, let's pull that up real quick, like it's basically gone parabolic, right? Here's wow, we're right up against that new high. So yeah, this is a very now that we're up 6, this is a very interesting point today, right at 192. So in this instance, you'd expect a little bit of resistance on going all the way back to this high right here. But if we do break through this high, I do think there's a good solid upside. So we're trading at a PE ratio of 23 at this point in time compared to the mega cap tech stocks, the Meg 7 in general, and just people in the space. It's the lowest valuation out of a lot of those stocks. So it's fairly valued in my mind. We have a strong move up. We're sitting right here. If we do get this move through 192 and it goes towards 194, I wouldn't mind just buying some long calls. You could do a spread if you'd like, and you probably could go out and do what we did in Amazon, where you got the big move up and sell the short put spread. But I really would like Google if we broke through the 194 level. So I want to put this on your radar. The fact that we're bumping up right here, this is we got candle kind of stick, so it poked its head up above this level, but it would be really interesting to see if we close right around the 192 level. So that makes it a tough trade today. If I did anything, I would do right. I'm looking over at these support levels right here. Looking at selling something around the one. Let's look at that. Let's just look at it, because I really wanted to do a trade, but I don't like the fact that we're bumping up against that new high. I like being long Google. I don't mind just owning the stock. I think they'll figure it out. They're not going to let AI. It's just too well of a run company to allow all the new AI services to just take away their search tomorrow. If it does happen, it's going to be years before they get there, and Google's going to fight like cats and dogs the entire way to try to keep their hold on search. It just makes sense. And on top of it, YouTube is killing it. They're getting all that free content, and yeah, they're just making strides everywhere. Okay, 192.53. 185 on a 2-day. Let's look at 1 week. 185. Yeah, we can get 11. Yeah, I don't mind this trade. If you want to do something like we did in Amazon, let's go back to the chart. 185 is right here. That's where the breakout began. If we could pull back to that. 180 is 42 cents. All right, let's split the difference. Let's do 182.50. And we go 9 days. We're going to sell this one and buy this one. 40 cents. That's not too bad. I really wanted to buy a long call. I don't want to get that bullish on it with the stocks bumping up against a new high. So let's sell a short put spread, and let's make this an official paper trade. We'll look at it this week. We're going to go in. There's a little bit of vol, a little bit of juice. We're looking at about 30% implied vol, which usually implied volatility has a tendency to go down as the market goes up. But if you see the historical vol, it's right around 24%. It's just very volatile to the upside. So I want to sell some of that premium, get a little bit of a play off of volatility in general. That could happen. But we'll see. 182.50. We're going to sell that one. 177.50. This is a legit bull call spread, bull put spread. and we're going to bring in a net credit of 40 cents to the account. That means that we're going to have $5 worth of risk, which is the difference between the strikes, minus 40 cents or $4.60. And this is a viable trade going out 9 days to the December 20th expiration. And we'll make that official paper trade for Options Guy TV. See a couple of comments, and then we'll start cleaning. I tried to close the SPX trade since this morning at 20 cents, still not successful. Oh, wow. Okay. Mega came in and said, try to close the SPX trade for 20 cents. Do you recommend paying more? Okay. So you put that up. Thank you. So you see the question there. Do you recommend paying more, 30 or 40 cents? I would leave it in at 20 cents. I don't mind closing it there. I think that's a solid point. If the markets, as you head into the close, and this is, actually, Mega, I'm glad you brought this up, because especially in things like the SPX, it is much harder. I wouldn't say much harder. It is harder to get a midpoint fill in the middle of the day than it is on the open and on the close. And now you're just getting into real world things where you're talking about the I don't know, SPX pit, maybe 1,000 people standing down, maybe 600. I'm trying to think of my days on the floor, which was quite a while ago. I'd say probably 600 people standing in that pit. They need to hedge their positions. They're willing to take on risk at noon, but at the end of the day, a lot of them want to close out their positions. It's not quite that simple, but bottom line is they're more apt to trade on the close at a midpoint than they are to do it at noon. That simple. So I would leave it out there at 20 cents for right now, and just let it work for a little bit. I'm really disappointed you can't get a fill at a net debit of 20 cents to the account. And that's the way I would do it. I would ride it, and I wouldn't want to try to take the market risk overnight and close it out for 20 cents. All right, that's it. Yeah, there you go, May. I hope I'm right on this. And it's okay if you do have to pay up a nickel. It's okay if you get up to 25 cents. But time decay is going to be a bigger issue right now than price. In other words, you do need the market to kind of hang where it's at. But time decay is going to be a big issue from Wednesday to Thursday. And that's a huge trade in the SPX. All right. And if you ride it overnight, so I would actually look at it, Mega, this way, in that if I had two on, maybe I close one out and let one ride overnight. You still have the buffer, but you need to get through Thursday to really make it profitable for that peak. And I think I showed that with the what if calculator. Enough. That's it. We're over time. Thank you so much for coming. What an eventful day here on Options Guy TV. We will be back this Friday. We're going to look at our Google trade. If we do break out to the upside, we can close somewhere around, let's say, 192.5, 193, and we get a solid close above that new high. Then I don't mind getting long some option contracts, some call options in Google. We can do it via spread, or we can do it with an outright buy. But that's the way I would look at it. And it's still trading at a decent valuation. I wouldn't even mind owning the stock here going into 2025. Thanks for stopping in. My name is Brian Overby. I am you can follow me on Twitter. My handle is @BrianOverby. And check out my website, optionsplaybook.com. I always kind of forget to offer that up, but everything on all the content is free on optionsplaybook.com. So check it out. Thank you for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.